So, you've heard that the recession is here, seen markets begin to plummet, and decided that now is the time to throw all of your money into stocks and crypto. Wait, before you do, I want to share some tips and tricks that can make your jump into investing that much easier and hopefully help you avoid some mistakes that could cost you a lot of money. So with that, let's jump into the first tip, which is having an emergency fund set up. Before you begin investing, you want to make sure you have an emergency fund set up, which is basically an amount of money put aside that can be accessed in any unforeseen financial situation. This can be anything from an unexpected car repair, a medical expense, or a temporary loss in source of income. This sum should ideally be kept as cash in a large interest savings account or in other assets that you can easily liquidate in 3 to 5 business days. An emergency fund should ideally be about 6 months worth of your salary, but I know this may sound daunting, making you hold off for 6 months before investing. However, this is just a general guideline. Make sure to at least have $500 to $1,000 set aside, and then every month you can continue contributing towards your emergency fund until you reach a sum that you're comfortable with. That brings us to our second tip, which is determining your risk level. Investing can be risky, but the beauty with investments is that there's so many different types, each coming with their own different risk levels. If you're more conservative and want to ensure that your investment grows slowly over time, then maybe you should be investing in high interest savings account, high yield bonds, or broader index funds that follow the entire market. If you're open to a little more risk, accepting that your portfolio might fluctuate in the short term, then you should offer traditional stocks that have generally seen returns of 10%, but go up and down in the short term. And if risk is no problem for you, then you can look at cryptocurrency. Here you have to have the mindset that there's a very high probability that you may lose a large part of your portfolio. Of course, these are just guidelines based on different types of investments. In reality, only you can determine your risk level and you can decide what you should invest in and make your plan accordingly so that you reach your target risk level. No matter what, make sure you have a clear idea of what your risk level is before you begin investing. That brings us to tip number 3, which is stick to what you're good at. Investing requires a lot of research, and if you're managing your portfolio on your own, then you have to decide where to allocate your funds. There are so many places where you can put your money that it's almost impossible to keep on top of the research for all of them. That's why the learning curve is so much easier if you invest to begin in sectors where you have knowledge and are passionate about them in your day-to-day life. For example, if you're really into cars and are on top of all the new model releases and all the new technologies that are being implemented, it just makes sense to begin investing in car companies because you'll already know a large part of the research just because of your love for cars. The same goes if you're a total tech geek and know all the new hardware that's about to come out. Into the healthcare sector and know the new treatments that are about to appear. Into renewable energy sector or any other sector for that matter. You essentially have an edge on others that may be starting to invest in these sectors because you already know what's new and what's happening and what's about to be released. Of course, there are many more aspects to research than just knowing the product. You will need to search for their annual reports, their quarterly earnings statements, their financial statements, and look at the overall growth of the company to see if it's sustainable in the long term. Research when it comes to investing is just as much about trying to predict the future and what's going to happen with the company as it is about looking in the past to see what they've already done and how they've grown, how they've handled situations, and if they have a promising outlook for the future that can sustain its trajectory. As you become more experienced, you're going to start diversifying into all types of different sectors. But to begin, it makes it that much easier if you step into something that you're already familiar with in your day-to-day life. Stick to what you know to start. Make your life easier. That brings us to tip number 4, which is don't keep all your eggs in one basket. Diversification is key. When you first start to invest, after you do your research and you find a stock or a company or a coin that you're really into, you're going to want to throw all of your money right at it off the bat. Don't. Even if you have struck gold, it's important to remember that you don't want to put all of your funds into one asset or commodity. The main reason for this is that even if currently one of your stocks may be soaring beyond your wildest imaginations, it could just as easily take one bad piece of news and plummet 30% overnight. Your goal as an investor is to be protected and absorb as many shocks as the markets may throw your way. If you're 100% invested into oil stocks, and a piece of news comes out about a law being passed that's going to ban all diesel cars in the next 5 years, then your stock might drop 25% overnight, essentially meaning your portfolio has dropped 25% overnight. If, however, only 25% of your portfolio is in oil stocks and another 25% is in renewable energy, then this shock wouldn't be as large towards your portfolio. And on top of that, you would be protected because the renewable energy stock would probably soar at the same time. kind of counterbalancing the reaction from one another. Generally, it's a good idea to set percentages for different sectors for your portfolio, so that way when you add more funds towards your portfolio, you can reallocate and redistribute so that you stay as close to your proposed percentages as possible. Diversify, diversify, diversify. And that brings us to our final tip of the day, which is tip number 5. Don't try to beat the markets. In the investing world, there's an old saying that goes, time in the market beats timing the market. There's a difference between being a day trader and an investor. I personally consider myself an investor because I think long term, and I suck at day trading. The reason many people end up performing poorly as day traders is because the markets are very unforgiving. It's almost impossible to perfectly time a top before a huge sell-off or a bottom before a stock begins to soar. If you do happen to consistently do this, then you're either very, very skilled or very, very, very lucky, which it's probably the latter. The best thing to do is not to try to beat the market, but to simply zoom out. If we look at the S&P 500, we can see that it's historically gone up by 10% each year. This includes all bad years and all good years. The average of this is still a positive of 10%. Of course, if you're incredibly unlucky, you can definitely buy a top and then see your stock go down by 30% over the next year. However, if you wait maybe another 3 years, you wouldn't only recuperate your initial investment, but also make another 20% profit on top of it. If you would have been devastated after the original 30% short-term loss and decided to sell your stock to try your luck with another one, then you wouldn't have had the opportunity to not only make your money back, but make profit on top of it. This is why you should give investments the time they need and let them grow for you on your own. Don't stress about the short-term fluctuations. If you could see into the future, you'd easily be able to call every investment perfectly. But unfortunately, you most probably can't see into the future. So in this case, just stick to getting into the markets as early as possible and let time do its magic. Beginning your investing journey can be daunting. All these charts, numbers, facts, news reports, opinions thrown at you left, right, and center. However, if you manage to take it step by step, focus on your investment style, your risk tolerance, and your investing strategy, then you're already one step ahead of other people that are just throwing their money at different assets that they see online without any prior research. As always, I want to thank you guys for watching. If you did enjoy it, please make sure to subscribe and leave a like because it does help out. And if you have any questions at all, just let me know and I'll help to the best of my abilities. As always, this isn't financial advice, but I am here to help if I can. And that's it for now. See you guys next time.